Hello and welcome to another episode of the SwingTrader Status weekly update. It's Justin Nielsen here, along with Mike Webster, our senior market strategist and the brains behind SwingTrader, and also 1 year older now that he just celebrated a birthday on Friday. So he decided not to show up to work that day because he was off gallivanting with his daughter.
I'm only 33. I look
33. Okay. Yeah. More or less, give or take.
Yeah.
Well, you know what, folks, don't he's better at numbers than that. Don't worry, folks. So yes, happy birthday to Mike. And let's get into it, man. Well, first of all, how was your vacation?
Lovely. It was wonderful.
You missed the whole CrowdStrike debacle. So
yeah, I missed it. We were traveling in Yosemite, and it was just, it was wonderful. And it's so beautiful. Can't wait to go back.
Awesome. Well, while you were gone, we actually had the market just to kind of got a little listless, didn't know what to do without you. And the end of the week, it was basically like, oh, there's no Webby here. What are we going to do? And so the S&P 500, I've got SPY up right now, 3 days down last week. And we got below the 21-day moving average line, bouncing a little bit. But is this enough, or what do you think?
Yeah, I don't think so. Frankly, there's this rotation that is holding this time. We've been joking about the rofaction, that Dominic Gessel coined. And because every time it would look like we'd be rotating into one group or another, whether it was semis to chips or to small caps or what have you, that the rotation wouldn't hold and it would just be short-lived, maybe a day or two. This time, it looks like if you can pull up IWM, which we're going to talk about later, that this rotation does seem to be holding this time, and it feels significantly different. And I do have a position in the IWM, and we have it on the list, of course. But going back to SPY, it seems like, and sorry, I'm fighting a cold, so I'm trying not to cough. It still looks like it's in a weak position. This is not, a normal strong bounce that you would have. Of course, our low is back above our 21-day, but we closed down on the day, and that's just kind of a weak position. Excuse me. It feels like it's kind of a magnet for testing those lows from last week, if not even going lower.
Yeah. And, just for those of you that might be familiar with our market school rules that we came up with, gosh, that was over a decade ago, along with Charles Harris, of course. One of the things that we did say, we had as one of our signals, the B3, a break above the 21-day moving average line. But as you mentioned, you need to be closing on an up day when that low gets above the line. And that's not what we got today. I want to turn back to IWM, which I also do have a position in this myself. It was a kind of a ugly 3 days for IWM as well. I mean, we've got starting with a reversal that we had on Wednesday, and then it was a pretty brutal day on Thursday. Not too bad on Friday.
Yeah, so Friday's action was great, frankly, because that was a technique that, I learned from Bill O'Neill, the founder of IBD, that when you're coming down, whether he would typically do it on weekly bars, but when you break the first week, so that was your downside reversal off the top, you look at that percent, and then you see where it increases and where it decreases. So that day we're down a little over 1%. And then the following day, we were down a bunch, almost 2%. So you're accelerating the selling, but what you're looking for is that selling to dry up. And that's what happened. That next day was only down 0.5%. So significantly less than the day before and less than your first day. So that was a sign, along with some other things we're going to talk about, like the 50% retracement, where it was slowing down, acting in a normal fashion. So 3 days down after a big move up is normal. So that was as beautiful as it gets and as kind of as classic as it gets. And just to make it a little bit better, we had the outside day yesterday where we undercut the low of Friday and went and closed above the high. So that was exactly what you want. So now that puts a new line in the sand at yesterday's low. So you can raise your mental stop or your physical stop to yesterday's low, certainly on a closing basis. It wouldn't be normal if we're just going to continue higher, for us to undercut and close below yesterday's low. That could happen if we form a shelf here, but if it does what it looks like it's trying to do of just moving out, that wouldn't be normal. So you're always looking for clues of what's normal, what's abnormal, and frankly, SPY and Qs going lower would be normal, but we're in the middle or the very beginning of earnings season, so it's going to be dictated by the Mag 7 earnings and their reactions. But I would think that the normal gameplay right here would be small and mid caps continue their advance while the large caps struggle a bit.
And let's go ahead and since you mentioned the Qs, we can't leave them out. Qs down below their 21-day moving average line. Tried to get up there today, but got turned away right at the 21-day moving average line.
Yeah, so this looks like a classic weak position where you had your downside reversal at the top, then you had your bad break of your 21-day, which made it look like a magnet to the 50-day. So typically, I'm so sorry about my coughing, that it feels like it just wants to touch that or undercut that a little bit, and that would be normal. Now, anything above that means it's abnormally strong. So we're not trying to predict. We're just trying to look at the action and say, what would be normal, especially getting stuck underneath the 21-day. Today is a bad sign.
Yeah. So you've got some charts that you wanted to show between the retracements and the regression channels. Where do you want to start?
Let's start with a SPY.
Okay.
We're going to start with a regression.
Yeah. So we're going to switch our charts from Market Surge, and you're using, is this TradeStation?
Yeah, this is TradeStation that we're going to be on first. And you let me know when you can see it.
Yep.
Okay. So this is the regression that we normally talk about on our Friday SMT that I typically do with Allie, but since she's away on vacay, I think I'm doing it with you, right?
That's right. That's Friday. You and me.
Can't wait.
Get the band back together.
Yeah, love it. So the regression that we're using on here starts on April 22nd, and it goes out 50 trading days. So that goes out to July 2nd.
And why did you start on April 22nd?
So I like to start these regressions at inflection points. Sometimes I'd start them on follow-through days, but I've been switching from starting them on follow-through days to starting them when the trend changes, and it's typically your first big day up or anything noticeable of a character change, because the thought process behind a regression is it's just a line of best fit. So it's just saying between these 2 points, all the data, just draw me a white line in between there that basically evens everything out, is the easiest way to think of a regression, a line of best fit. And so you want to start it at the inflection point, and then you want to go out a set number of days, because otherwise, if you just keep on bringing it out and out and out, it's going to get wider, and you're essentially data fitting. And so I like to say in advance, I'm going to go out X number of days and stop it there. And 50 days is what I like to go with these days. You could make an argument that it should be shorter or longer. This is an art. It's not a science. So I'm always changing it. And I use the average of the bars. So it's the high plus the low divided by 2. So the average. And right now I'm using 1 standard deviation above, as well as 0.75 deviations above and below. So that's what the 2 green lines. This one here is your 0.75. This one is your 1. What does all that mean? It's just a bunch of nonsense, right? It's a way of objectively looking at the trend and letting you know when the trend has changed. So it's what these lines are telling you is from April 22nd to July 2nd, what was the trend, just based on the data, not based on your opinion. And once you start going below those green lines or above those red lines, it's telling you something. If it goes above the red lines, it's getting a little too hot and you need to back away. It's going below those green lines and staying below that, then the trend has changed. If it just comes into the green line and bounces, that's where you slam on the gas, because it's basically telling you that it's probably going to mean revert, meaning going back up to the white line, which is your regression or your trend line. So
Mhm.
it's just something that I've used for some time. Bill never used it. He didn't need to. He could just see this in his head. It helps me. So
So you got the SPY coming down to the not quite to the 1 standard deviation, but to the 0.75 standard deviation. And yesterday we got a bounce. So is that time to put on the gas?
it was looking like it might be yesterday based off of SPY, but today's action of stalling there, a form of stalling, is telling you that it did exactly what you don't want it to do. When it's bouncing off of something, you want to see some power and some strength there. And so you would have expected today for us to have a big move up. Kind of like what we saw back here on May 31st when you came down and touched that line, you had some real power over the next few days. So
Mhm.
for this regression to be, staying in character for SPY, we really need to see some power right away, like,
Okay.
tomorrow or the next day for sure. Let's look at cues because it really tells a different picture. And here we actually broke through it. Or I guess first I'll show the composite because that's more broad based. And you can see it's kind of like SPY, but it's undercut your 1 standard deviation, came up, found resistance at your 0.75, and has come back down. But Qs are really kind of how we think about this current market with the Mag 7 and all. And we broke it, which why I use this is so you don't make excuses to yourself like, oh, it's just a dip or, it's just some normal weakness. It's a change in character at this point, just a small change in character, but it's enough to change how you're looking at things. And that started, of course, with this big day up here. And it's just, we've seen more of this weakness with that gap down. Now we're underneath the 1 standard deviation. So you've had a few closes below it, and certainly a number of them below the 0.75. So this is now breaking its trend. And so it's saying, you know what, we need to wait for a new trend to establish itself. So it's really not looking good for the Qs. But again, we're kind of in a news-driven market right now from the political side, which is impacting the market to a certain degree. That always happens around, election years. That's normal. But also on top of that, we've got the earning season that's just starting, as we mentioned. And so that's really going to dictate what this ends up doing. But right now, frankly, the Qs don't look good. And that's why we've moved out of the big caps and we're into the small cap area and the mid caps. And those are the ponds that we're fishing in.
Yeah. And just as a reminder for folks, as you said, the Qs are definitely a lot heavier in terms of technology weighting. Technology weighting is about 52% for the Qs versus 33% for the S&P 500 or SPY. Communication services, which includes, you got your, Meta in there, and that's 15.5 for the Qs, and just what is it, 9% for SPY. And then you've got a much heavier, Qs. Remember, that takes out financials completely, which is a strong area right now. SPY has 12% there, whereas it's 0 for the Qs. So yeah, a lot that kind of shows why SPY might be a little bit stronger than the Qs, but still not completely out of the woods, because it still does have that 33% technology weighting. Let's talk a little bit about retracements, shall we?
Sure. So we always talk about the 50% retracement. And again, that's something you can use from an intraday chart to a monthly chart and everything in between. And it's just a way of looking at moves and realizing that when a stock moves or an index moves up, it can retrace half of that move and be normal. And when it retraces, sometimes it doesn't even get close to half a 50% retracement. And that means it's even stronger. But if it does come down and do the 50% retracement, then you want it to start living above that midpoint. That's a sign of strength. Again, this is an art of where you start your 50% retracement. Right now, I'm starting this on May 23rd. That high there going out to our recent high, and this is on SPY, and you can see you came down, you undercut slightly your 50% retracement, and now we're still living above it. So that's still, okay, but we really want to see some more strength or more days where we're living above it here. On the flip side, we've got the Qs came down, went under it quite a bit, and now is having a hard time staying up there. So we had a close under that 50% retracement using the same dates on there. So that's just a sign of weakness. On the flip side, let's take a look at the small caps. And the IWM, we're starting at a different point because it really started moving on this gap up on July 11th. And so I'm starting it with the close here on the day before that. And so there's lots of ways you can do that. Again, it's an art. So July 10th, and then going up to our recent high. And you can see when we pulled back last week, and then even the open or the midday yesterday where it was weak, it was still holding just above that midpoint. Again, a sign of strength that we have there with the small caps. And you can see the same thing with the mid caps. Mid caps did come underneath that a bit more, but we're decisively above that midpoint. So it's telling you that for the moment that the small and the mid caps are certainly the pond to fish in, whereas the large caps are something that or certainly the mega caps, which is I think of it either the Fang U type of instrument, or what most people know is the triple Qs. And so it's just telling you where you should go right now, and that can change. And as anyone who's followed us knows, we're very flexible, so we will change as the market changes.
Mm-hmm. What about kind of a little bit more, I guess, sector area? You're kind of focused on the market cap right now, but what about like XLF, XHB? Those are two areas that we have been kind of concentrating on as well.
Okay, so the XLF, and it's kind of hard to see it in here, that same thing there, where we're still above it. We tested that 50% retracement, and I was starting that again on the July 10th, and you could see that we're back above it, but didn't close as strong as you would like. And then the XHB, I'm not sure if I did that one. Yes, I did. So this one is showing even more strength than the financials. So the home builders are really acting well, and it's why we've got positions in them. And I do have a personal position in the XHB. And so this is actually acting better than all of them, frankly.
Mm-hmm. Yeah. And, just as a reminder, this is something we were talking about last week, because IWM was so strong. It seemed important to kind of let people know that, hey, we were going to give this a little bit more room. If we came down 1% or 2 or 3, that wasn't going to be something that would scare us out, because that 50% retracement base. I mean, look, IWM had a number of days that were over 3% gains. So when you have a number of days that are that strong, you've got to expect some weakness on the flip side as that retracement happens. You mentioned kind of like where we're shifting a little bit. So maybe it's a good time for us to shift over to where our pie chart, because this is kind of a good way to show where our focus is right now. And I'm going to go ahead and start with, as we usually do, kind of our overall sectors. So if we go ahead and throw the pie chart up, you can see that right now we've got a cash position of about 8.8%. And then a little bit in finance, a little bit in home builders, a little bit in aerospace. But the bulk is in ETFs. So if we look at the ETFs and kind of break that down a little bit, our ETFs are kind of spread out between our small caps, mid caps, a SMID, which is kind of a combination of both. So, we've got a 78% in ETFs right now, and almost half of that is basically on the market cap side, just focusing on the small caps and mid caps that you just went through. And then we also have RSP, which is, still the S&P 500, but it's the equal weighted. So it just takes away that heavy market cap weighting that happens with $1 trillion club, your Googles, your Microsofts, your Apples, and so on. Beyond that, you've also got financials where we've got a 12.7, builders where we're a little bit heavier, closer to 20. And then our newest position, the aerospace defense, 6% there. And then gold miners that we're still holding on to, just a quarter position. It's hanging in there, hasn't broken down. So any comments on this?
Yeah, so we made the shift into primarily ETFs on purpose because this bull market has been led by SPY and led by the Qs and Nasdaq, and we're in this rotational phase, and we don't know how it's going to play out. We walk through what would be normal, what would be abnormal, but the fun part is you don't know. So we just have to take each day as it comes. And so there's that uncertainty there because we're no longer in that the same type of trend that we were. So shifting into the ETFs gives us a diversification. We can get in and out of them without getting hurt. Because they always have either the liquidity there or just the nature of an ETF. Even the thin ones you can get in and out pretty easily. And you're spread out. So the IWM, that's 2,000 stocks. The SMIDs that we have, that's thousands of stocks. And so it's a really broad base, especially going into earnings season. I think that's important. Now, as we start confirming this rotation, if the IWM continues, what we'll be doing is looking for stocks that are liquid enough for SwingTrader, that are small and mid cap, to put on and get away from the ETFs and go back to the individual stocks. So it's a way of playing defense while still playing offense. So we're having the market exposure, but we're doing it in a more diversified, safer way, as safe as the market ever gets, because anything can happen. I mean, IWM can blow up tomorrow, 2,000 stocks can go to zero. Anything is always possible, but it's
maybe unlikely.
Less likely, right? So if we had a bunch of individual names going into earnings, there's nothing wrong with that, but it just carries a different amount of risk. And so we're just reducing our risk, but we're still heavily invested. If you go back to that the earlier slide, you can see we just have a very small cash position right now. We wouldn't feel this comfortable if we had a bunch of individual stocks with that cash position. And so this is just, again, you don't have to, we say it every week, and we're going to say it every week, you don't have to follow on exactly what we're doing at all. You could just use the service as a way of learning a different style of trading. Take from it what works for you and discard what doesn't work, but just kind of think through what we're doing and why. And that's why we do this every week, just to let you know, this is why we've moved into ETFs. This is why we've moved into the small cap space and the mid cap space, because that is what's working at the moment.
Mm-hmm. You had some other charts that you wanted to show, kind of almost SMT-ish, that you're kind of getting into TradeStation and TradingView and some of the other charts that you look at. So what are we looking at here?
Yeah, and we'll be quick with this one. This is just, I call it my Bob Marley off high indicator, and it's the focus your eyes on the section at the bottom. The green is just measuring the percent off high in ATR, so your average true range, how much the index or the stock travels on any normal day. I use a 21-day ATR. So for the average amount of time.
And the ATR is the average true range. So basically kind of how much the stock moves on a regular basis, right?
Yes, thank you for that. And so the green is 0 to 4 ATRs off its high, and yellow is 4 to 8, and anything more than 8 is kind of your red zone, and that's more of your severe either bear market or really significant intermediate corrections. And I like doing this this way because it tells me, as a stock or an index is is trending up, but yet pulling back along the way, when is it abnormal? And you can see that we had an abnormal break here at this point. And then again, when it came down in over here, it wasn't as severe. And so I gave you the wrong math numbers before, I think, Justin. So throw out the numbers we were calculated before, because we were doing that off of the April. But anyways, at this point, at the end of May, we came down about 3 ATRs. This time we came down 3.5 ATRs. So we're still kind of in that green zone. It's still okay, but back over here in the end of April or mid-April, we came down, 5.6, 5.7 ATRs. And so at that point, that was much more significant of a pullback. And if that happened, again, then of course we would be underneath our 50-day. And let's just look at the Qs real quick on this one. Same thing back in mid-April, on April 19th, we came off about 5.7 ATRs. On the May 31st, we came off about a little over 3 ATRs there. This time, we're already came down into the yellow zone, saying that it was a little bit more abnormal versus our break that we had there in the end of May. So it was a bit more severe, and it's just another reason to be cautious. And so I think we'll save the rest of that for Friday, so we don't redo the entire SMT today.
Right. Well, and it's important to remember, like when you say, abnormal, it really is kind of a little bit more severe, because the reality is, this is kind of normal, right? It is normal to have pullbacks along the way. And, while we are below the 21-day moving average line for the Qs and SPY, there hasn't been like this big breakdown. We're just kind of in that more severe area, but not broken.
Exactly. Bending, not broken. And so that's a good place for the market to be, because it brings in a proper level of fear in the market. And you don't want something to just go straight up. If we would have just continued accelerating up, the way we were, and let me go back to it over here, then it would be extreme. In fact, I'm just going to toggle over to the Webby RSI for a second. I wasn't going to do that, but it's worth pointing out. And this is just if you focus down on here, if this is new to you, we talk about it every week on the Friday SMT. This is your low versus your 21-day expressed in ATRs. And without getting deep in the woods on it, this was getting 3 ATRs where your low versus your 21-day is at kind of nosebleed levels, and that's an area where you want to start reducing. And that's what happened here. We got right up to 3, and so that's why we were starting to get out of, and that was on July 8th, and we were starting to rotate out of the mega caps into other spaces. And then you could see that it was just too hot, and it pulled back in. This is normal. It's like a sine wave, goes up and down, goes up and down. And so it's not that the bull is over or anything like that. It's just now you're in this corrective phase, and when you're out of the corrective phase, essentially when you start getting a Webby RSI of 0.5 or higher, and that basically means your low versus your 21-day is at least half an ATR. And right now the ATR on Qs is 1.21, meaning on any given day from the high and the low, it travels 1.21%. And so half of that, so 0.6 percent, your low would be above your 21-day. That's when you know that you're kind of should be out of the woods, or at least your first sign that you're out of the woods. And then when that happens, we'll start gravitating more towards the large caps. But until then, because you never know how long these pullbacks are going to last, there's no way to anticipate the length of something, just what state you're in. And right now, our low is below our 21-day. And in fact, our high has been kind of stuck underneath there. That's a sign that you just don't want to play. Certainly from a swing active trading standpoint, you don't want to be in those, and that's why we're not.
Mm-hmm. And also as a reminder, when we're when the ATR is calculated, it usually is the high and low that you're kind of looking at that distance. But in the case of gap ups, gap downs, or big moves like that, it really does take a look at the previous day's close to kind of give you that range. So that is one of the things that the true range does a little bit differently to kind of reflect, hey, you know what? There was more movement than maybe you saw during the trading session because of where it came from the previous day. So a real interesting little tidbit there on how that's calculated. Just kind of looking at the past trades, we've taken some stuff off this week, mostly locking in profits on individual stocks. That included FANG, FDX, Generac, Toast. That was a nice move there. It was a higher ATR stock, so a little bit not something that we necessarily wanted to keep for that long. Just booked the profit there while we had it, and then also Aries. So again, some areas where we got some gains on there, just locked them in, and that kind of let us go a little bit deeper on the ETF side.
Yeah, and just as a point of reference for people, which ATRs are probably new to most people, the Toast that you mentioned, that's ATR is 3.95%. So basically 4% on any given day that it's going to go back and forth, versus like an RSP that we have on is only travels 0.9, so less than 1%. So that's why we have a comfort level of being a little bit heavier there. In contrast, the IWM right now is 1.57. So 1.5%, the average move that it will do. That doesn't mean it's going to continue. The average true range always changes. It gets tighter, it gets wider. But it helps us, like, we're not going to be doing Toast type trades for the near future because they're just going to be too wild for us. So we're going to be doing ETFs, which naturally have lower ATRs, unless you're doing leverage ones, and that's a whole different can of worms. Or, so that's the space we're going to stay in for now until we get back into a nice trending environment.
And since we were talking about Toast, just as a reminder, when you go to the past trades, if you do the calculation, when you look at the trade setup, and remember, you can go to the past trades, click on the symbol, open up the past trades. It gives you all the details of this is what, this is the day we bought it. This was the price. This is where we added. This is where we trimmed. This is where we exited. And then we also put in there the average cost, the average exit, and an adjusted exit price. And that adjusted exit price, for example, with Toast, it was only a half position at the most. So even though it was up over 4%, when you take all of those numbers from the average cost to the average exit into consideration, we only gave ourselves credit for half of that, because that's why it shows up as 2.12, because we're only giving ourselves half credit because it was a half position. So it just kind of makes it so that we're doing apples to apples comparisons for all the different position sizes. Full positions, we don't make any adjustments. Quarter positions, we're going to make, more of an adjustment. And that works on both the upside and the downside. So for Toast, we didn't get as much credit for it because it was only half position, but for losses, we only take half a hit, so that's the way that we try and keep it consistent in that way. So I know that was one of the questions that was coming through from customer service. So just as a reminder, that's the way we do that. Now, as a reminder, we did just recently add on the current trades, we added the position size. So that's something to kind of help you kind of recognize where, where we're kind of shifting things. Are we a little bit light over here? And sometimes we're lighter because it's a higher ATR. So we don't want to increase our risk too much. With the ETFs, as you mentioned, we're much heavier in a lot of those. In fact, we've got IWM as larger than a full position. So that just kind of shows you, okay, we're willing to go a little bit heavier there. So, my Google just, I set something off on my Google. But anyway, any closing thoughts there, Mike?
Yeah. So, we always pay attention to the feedback. And, one of the things that we're going to try to do, because we know that the number of alerts that go out sometimes can be a little bit overwhelming for people. And remember, I've said it once, I'll say it every time, that you don't have to do every single thing. But with that in mind, we want to make sure that this is a product that's accessible to as many people as possible. So we're going to try to slowly, gradually tone down the number of alerts. Of course, if the market dictates us moving a lot, we will, but we're going to consciously try to slow it down a little bit, just because we've been hearing a lot of people that, you've got jobs, maybe you're off in Yosemite with your family having a good time and you're getting all these alerts and you're like, geez, will these guys slow down? We're going to try to slow down a bit. So hopefully that helps out. And we're always going to be fluid, and so we'll change. That's something that we always learn from Bill. You always say it, Justin, of iterate, iterate, iterate. So you're always just learning, and we're going to be adjusting.
Yeah. Well, hey, thanks a lot, everyone, for joining us this week. As Webby mentioned, we're going to be together on the SMT video, the Stock Market Today video on Friday. That's an extended version that we do on Fridays. I'm going to have a podcast tomorrow where Mark Minervini is going to be on. So that's going to drop on Thursday. So we're continuing the education throughout this week. So we really appreciate you joining us for this one, and we'll see you next week. Ta-ta.